Hello, everyone. On today's edition of The Final Bar, we'll recap today's market activity, talk about the continued rally in U.S. equities, what that means for the long-term trends. In a session called ETFs ENGAGE, we're going to talk a little bit about factor ETFs, about momentum versus value, some of those plays that a lot of institutions are making and how it relates to your portfolio. We're going to also have a shifting stock segment, and my guest, Samantha LaDuc. I'm pretty excited to have her on the show to talk about her macro perspective. So ladies and gentlemen, this is The Final Bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a chilly Redmond, Washington. Thanks for joining me today and every weekday after the close. The goal of this show, hopefully you know from having watched it before, it's to look at the short-term price action today from a technical perspective, but connect it to the longer-term trends. It's so easy to get caught up in that short-term fluctuations in the market. And one of the biggest penalties, I was doing a podcast interview this morning, and I reminded the host, one of the biggest penalties or fouls that an investor can make, a long-term investor, is to make long-term decisions based on short-term data. And when you look at a lot of charts, a lot of times you can fall victim to that short-termism where you're focusing too much on the flickering ticks, the short-term trends. So let's make sure we have a proper orientation to the long-term trends. So today we have a guest, Samantha LaDuc, who's going to share some really interesting charts about growth versus value, also just a take on the macro environment. Pretty excited to get her take on where we're headed here to year end and into the beginning of next year. And in a really interesting segment called ETFs ENGAGE, we're going to talk about factor ETFs and how to think about them. Something on the institutional side, many are doing. So a lot of really cool stuff today on the show on The Final Bar. I did want to point out, however, we have a special event coming up on January 4th called Market Vision 2020. I'll be speaking during that day-long event. Also, my counterpart, Chief Technical Analyst here at StockCharts, John Murphy, will be the keynote speaker. Also, a lot of the hosts from StockCharts TV that you're probably familiar with, guys like Tom Boley, Greg Schnell, Julius DeKempener, and others. So it's a really fantastic event. Also, I did a webcast this morning about investor routines, your daily and weekly routines. You go to the YouTube and go to the Earnings Beats channel. You will find that video from earlier today if you missed it. But let's get on through the final bar. We're going to start with our market recap. And again, my goal with this show is not to focus too much on the short term, but focus on rather how the short term connects to the longer term. So today we had a bit of distribution during the trading day, even though the market closed higher than it did yesterday. Overall, a little bit of distribution as things went on. We sort of sold off toward the close, sort of a nice little fizzle out. So it wasn't a huge momentum day of any sort of a way of digesting recent gains. And that's okay. Even in a healthy uptrend, you're going to have periods of digestion of backing and filling of ways to sort of process previous gains. Otherwise, things just go straight up and then they collapse very quickly. So it's very much a healthy sort of bar within a context of a bunch of higher bars. Looking at the daily chart, the challenge we have right now is that we don't really have a good context for where we're at, right? So normally I would say, look at the chart, look to the left and see where we're at relative to significant support and resistance levels. Unfortunately for now, or I guess fortunately if you're long, we're in uncharted territory, right? We keep making new highs. So I think what you need to do is switch gears mentally. You're not in range-bound mode, you're more in trend-following mode. And there's two things you can do about it. Number one, make sure you have a good read on the trend. And in this case, Charles Dow, higher highs, higher lows. So the continued pattern of higher high prices is the most important trend. As long as that continues, then by definition, the trend is positive. The other way you can do that is with moving averages. We have long form moving averages sloping upwards. That's a healthy uptrend, which is good. So that's the first thing, is to find the trend. The second thing you look for is any indication of trend exhaustion or potential trend exhaustion. And here we have a potential bearish divergence forming with higher highs in price, lower peaks in the RSI. That is not complete yet. It's not done. And that's why I'm not saying, look, this is a raging sell signal because we have a divergence. It's just the beginning. It's a potential divergence, but this is what you put it on your radar. This is why this chart is really interesting one to watch. going forward to see how things sort of evolve from here. Let's look at today's trade, and you can see what I was saying about a bit of distribution. That last 30 minutes, we really rolled over back to yesterday's close, almost closed at a very similar level to what we did yesterday. So, not much of directional movement really yesterday and today, very compressed compared to the last couple of days, right? Last week on Thursday and Friday, we had a lot of choppiness, a lot of volatility, and then we've sort of gone into this week. So far, sort of holding gains, but not really dramatically improving is sort of the way I would think of it overall. Let's look at the member dashboard page. And again, this is one of the most important pages in your StockCharts account, in my opinion, because it demonstrates where we're at from all the different ways we can slice up the investable universe. So here, looking at equities, we can see the S&P really flat up 0.03%. That's a rounding error. That's not really much there. But this is where the really interesting signals come from. Small caps up 0.8% almost, mid caps up 0.3%. So even though the broad index was essentially flat, if you look at small caps, look at how those appreciated. And this is when I talk about looking under the hood, looking sort of second level at what's happening below the broad market indexes. That's where something like S&P outperformance, small cap S&P 600 outperformance may not have been obvious if you're just looking at the broad index, but here you can see how it incredibly improved. That's a sign of actually a more of a healthier market than maybe the S&P chart would indicate. At the sector level, we had consumer discretionary up over 0.5%, definitely the leader out of the 11 S&P sectors. The rest are sort of choppy, flat financials. Utes up a little bit. At the bottom, we had real estate. So there's certainly been this rotation away from real estate. One of the strongest charts up until the last couple months, really showing more distribution, really rolling over. And we can see it continuing to test new short-term lows. I thought it was really interesting to note that technology was actually second from the bottom, which you would expect, all else being equal, tech to be up here, utilities to be down there. That happened yesterday as well. We had some really interesting sector themes. So I would always encourage you, look at the RRG, the relative rotation graphs. Think about sector rotation, not just in terms of what should do well based on the market environment. Make sure you're looking at the sectors themselves and really pay attention to what's happening. We have a segment later about shifting stocks, so I don't want to get too deep into the equity space, except to point out that airlines, talk about a group that had been one of the least attractive sets of charts that all of a sudden starts to look a little more interesting. And Alaska ALK, the top gainer on our scooter reports. We're going to look at those a little bit later. I wanted to finish off, though, by looking at ETFs. So the top ETFs today, all Asia-oriented, right? So we have South Korea up almost 2%, again, on a day when the S&P was essentially flat. China all up very well. So those charts, again, have rotated from being, relatively weak, sort of frustrating sideways charts. Look at the chart of the MCHI. This is the iShares MSCI China ETF. We also look at the FXI occasionally as another measure. Testing resistance, pulling back to the 50 and 200 day, now breaking above. I sort of indicated this, what I call a bull flag pattern a couple weeks ago, and that's certainly resolved higher. Now pushing to retest the all-time highs there on the MCHI. So certainly a rotation to more of a positive signal from a lot of EM, also India at the top. At the bottom, we have sort of developed Europe really leading the way lower. So certainly a move more towards emerging markets. And that's a pretty interesting pattern to think about going forward, going into year end for sure. So that is our market recap for today. Again, the S&P sort of holding up okay, not breaking down, but not really gaining much. But there are plenty of opportunities for potential upside. This is where I think stock picking and asset allocation can become so important, because you're not gaining a ton right now just from stocks, but there are ETFs and equities that are certainly giving you some potential outsized gains. So worth paying attention to. Next, in this show, we are going to move to ETFs ENGAGE. This segment actually came from a lot of requests that we had from customers with questions about ETF structure. So when we open up the Final Bar mailbag, I'm getting questions about growth ETFs, about the XLF and what that means, about weightings of stocks, how they're calculated. And we realized it's a great ongoing segment to try and dispel some of the myths and hopefully fill in some of the information you may not be familiar with in terms of what ETFs are, and in terms of the different ways that you can gain exposure. On this segment, we're actually going to talk about factor ETFs, and this is one that's become more and more popular. These really didn't exist, a number of years ago, and have become very, very liquid, very, very popular. And I think a lot of that is driven by institutional interest. So in my time as an institutional investor, we talked a lot about quantitative investing, which is essentially investing in baskets of stocks with certain characteristics. And you always think in terms of factors. So the Bible of quantitative investing, what they call, talks all about factors, introduced factor investing and talked about how to orient yourself to different factors. So I'll tell you a little bit about what factors mean, and then I'll show you the ETFs and how to think about those in terms of your own investing. So number one, these ETFs represent 5 of the most commonly used factors in investing: momentum, quality, size, value, and minimum volatility, or a play on volatility. And essentially each one of these is based on the idea of gaining exposure to a certain factor, a certain style of investing. Now, when you talk about quality, for example, what they're doing is they're looking at the characteristics of stocks with good quality, good signs of quality, solid earnings, good businesses that are able to grow. And so when you talk about a move to quality, you're talking to strong earners that have stood the test of time, sort of the quality companies out there, for lack of a better term. So in general, the way that you think about a factor is you take all of the stocks in a huge universe. Let's say you have the Russell 1000, 1,000 or so different stocks, and you rank them on some measurement of quality, some metric, whether it's earnings growth or something, right? And each one of these factors have some primary way or multiple ways that you can sort of measure it. So value, you're looking at some sort of valuations, price relative to earnings or something like that. Volatility, you're looking at a volatility measure and where it's at. And then what you do is you rank the stocks from 1 to 1,000, and you put them in order in terms of their rating based on that metric. So what are the highest rated stocks based on quality on a certain look back period? What these factor ETFs now are trying to do, and what you do as a quantitative investor, is bet on the stocks in the top decile or top quintile or whatever it is, the strongest stocks based on quality. And that's talked about, that means you're gaining exposure to the quality factor. So these ETFs are actually designed to give you exposure to momentum, to quality, to size in a meaningful way. The challenge is there is no perfect, easy, or a tried and true or consistent way to gain exposure. You have to make some sort of assumptions on your model. And so some people are skeptical of momentum because it's not a pure play on momentum. It's a play on how iShares MSCI has decided to define momentum and how they've decided to structure the ETF. So maybe a little different than a quantitative investor at a big fund trying to make a play on the momentum factor. But essentially what each one of these is trying to do is as such. Momentum means you are betting on the strongest price performers. I'm going to own stocks that have performed well up until now. The second one is quality. I'm owning strong quality companies, strong earners. Size, I'm actually betting on the smaller companies versus the largest ones. Value, I'm looking for low valuations. And minimum volatility, I'm looking for lower volatility names. And each one of these gives some sort of exposure. So the 2 ways that I use these factor ETFs, number one is just looking at them individually and just seeing how they move. So what's happened recently is the momentum factor on a price basis actually looks pretty attractive, but on a relative basis, you can see that the relative line has rolled over, meaning that even though momentum as a factor has held up okay, it has not kept pace with the overall market environment. As a result, that momentum factor ETF has really underperformed over the last 3 months. It was up 6% essentially year to date. Now it's essentially flat to the S&P 500. Other factors have done much better. And again, each one of these will have a good illustration of that. One of the ways I like to illustrate these factors together is to run what's called a performance chart and compare each of these related to one another. So here I'm looking at the S&P 500, sort of this thicker black line in the middle. And then in order, I'm looking at value, quality, then here's the S&P in yellow, it's size, and then momentum, and then minimum volatility. And the key here is the starting point. So I'm starting from that sort of interim market low in August, that first week in August. Stock came off a little bit before sort of rallying into where we're at now. So I sort of started the clock there and I saw what factors have done well during that period when the market's done well. And so you can see the S&P is up 13%. 2 of those factors have actually outperformed: quality and which one is this? Value. Quality and value have outperformed. On the bottom, you see the factors that have underperformed. Momentum down here at the bottom, minimum volatility as well. So depending on where you start the clock, you'll see the performance characteristics of each of those factors relative to the S&P 500. My cautionary comment to wrap up this discussion on factor ETFs is to remind you that if you're buying something like a quality ETF, you are not just gaining exposure to that factor. By buying a quality ETF, an ETF focused on the quality factor, you are, by definition, you're inherently gaining exposure to a lot of things. You might have a cap bet in there, right? It might favor small cap companies right now, which means if small cap stocks outperform, the ETF's going to do well, even though it might not just be that factor that's driving it. You might have huge sector exposure. So if you look at minimum volatility, there aren't a lot of high-flying technology names that are going to be in the min-vol ETF. So as a result, you're sort of underweighting that group. So if sectors are not in that factor, they don't rate highly in that factor, you're going to be underexposed. So a lot of people, I think, incorrectly think that these are a pure bet and you're immune to all these other things going on. Remember that when you look at one of these factor ETFs, you are actually putting bets on that may be unintended, and especially in terms of sectors. So my reminder to you, my caution to you is to make sure you look at how some of these are constructed, because you may or may not be getting the particular exposure that you might be looking for. So that was a session on ETFs ENGAGE, talking about factor ETFs. And again, if you have further questions that I didn't get to, just shoot me an email, thefinalbar@stockcharts.com, and in a future mailbag session, maybe we can go in a little more detail on some of those points that you may have missed. We're going to take a quick commercial break. We're going to be back with my guest, Samantha LaDuc. Really excited to share her thoughts with you. So we'll be back in 1 minute. Welcome back to the show, The Final Bar. Thanks so much for joining us. Really appreciate it. Want to welcome on my guest, Samantha LaDuc. She's an independent stock market analyst and active trader. Samantha, welcome to the show. Thanks for joining us.
Thank you for having me.
You took some time to send us some charts ahead of time, which I really appreciate. The first one was really intriguing, looking at unemployment versus the S&P 500. What is this telling you about the macro environment here?
Well, first and foremost, I like to pull back in time and look at the macroeconomic backdrop as policies dictate price, and this is most often a lagging indicator. But with intermarket analysis, some technical analysis thrown in, it becomes very, very interesting inflection point where on a monthly, the unemployment claims have finally really triggered above the 24 moving average, and you can see that this is in the past kind of inversely related to the S&P. So I am not saying it's not going to go back down underneath and chop around a little bit, but it's intonating an inflection point, a change. And then I dug in a little bit more, because obviously I'm not going to just start shorting, calling this a top and become a perma bear. I'm very much a bear bull. I lawyer each side. I'm trying to find the position of both. So jobless claims obviously reported last week. Much higher than expected. Retail sales were also much lower than expected. And I use this track basically to kind of identify visually where we're going potentially. And then I researched, we've got a macro backdrop coming up in February where there's going to be a negative adjustment for prior period in non-farm payrolls that will revise downward up to 500,000 jobs. So that's about 40,000 jobs per month. We could have impetus for this to turn around solidly, and with that, some market pressure. And on that, back on November 1st, when we kind of broke out, if you will, we moved 100 points, and since then we moved maybe another 100 points. So nothing bearish in price action. I'm not claiming that we haven't had great trend trading, if you will, but I do look at the risks, and I'm looking obviously very much at the fact that we have a coordinated central bank easing effort going on worldwide. In other words, they're not just easing with rates, they're doing QE. So where's the panic buying? I want more.
Right.
So basically, I'm looking at this going, we really should take a little care just in sentiment alone that we have had, global liquidity back in August of 2018, peak, if you will. We had yields back off solidly October 3rd, 2008, rollover strongly. We have just curious, I think, major banks adding liquidity, and we have not yet done our panic melt up. It's kind of, it's pretty orderly, wouldn't you say?
Absolutely. And it's a fantastic chart. And I'm always very interested with trends that have been in place for so long that I think a whole generation of investors now have not invested in an environment where unemployment is going up. It's uncharted territory, pun intended, which means, I'm always interested in environments that people might be underprepared for, right? They just haven't experienced it yet. Now, the second chart that you sent was, getting a little more granular in terms of growth versus value. Can we talk about that take? What is this showing you?
Yeah, it's basically, I'm looking at rotation. So it was, very nice to see reflation, trades in commodities start to move higher, copper, iron ore, and that whole XME contingency, come off the bottom. Oil and gas has been a beautiful trade, off the bottom if you're swing trading in a smaller time frame. But ultimately, it's this momentum to value rotation that I'm really looking for to identify when it's time to, be careful. In other words, if they sell Apple and Microsoft, which are momentum plays, and money starts rotating into the oversold, bottom fishing value plays, be careful. And this is not triggered short. It's a trend line, going back, if you will, and it's in a relative strength. It's a ratio, basically. And if it breaks that little red trend line, I see cause for a market correction, and it would be very, very interesting to see if we bounce here, in which case market will be fine. Momentum trades are in control. Or if we break, which right now it's intonating a potential inflection change, then money comes back into the oversold stuff, think reflation trades, and out of momentum. So the cloud plays, the unicorns, the Microsoft and the Apples of the world. And if they sell Apple and Microsoft, why buy anything else?
Those are two fantastic charts, Samantha, and I love the second one. And again, you've highlighted two potential outcomes here, or maybe one outcome, portrayed with two different lenses. But it's an environment that I think a lot of people are not necessarily prepared for. It would certainly be a changed environment that I think, a lot of investors would be caught potentially on the wrong side, at least to start with.
And also bonds. Bonds are not
Yes.
excited about this particular move higher, and maybe because they know this combined effort of fiscal stimulus, monetary efforts are going to jumpstart inflation, and nothing is worse, obviously, for bonds than inflation. So I think this is very, very interesting year-end action, if you will, but being careful into the new quarter, I think, is merited.
These are two very helpful charts, Samantha. We have to move on, but I want to thank you so much for sharing your perspective. Thank you for coming on the show. We'd love to have you back in the new year, all right?
My pleasure, David. Thank you. Happy holidays.
All right, that was Samantha LaDuc from LaDuc Trading with two really interesting charts. And again, we've talked on the show before about the importance of some of those themes that might be different, what might be changing going forward. So two charts to keep an eye on. But we are going to move on, folks, to shifting stocks. We have a few moments to highlight some of the stocks that are moving. And again, the way that I tend, if someone asks me what's moving, I always go to the member dashboard page just to highlight stocks that are in flux. And I hinted at the theme a little earlier about airlines. And if you look at the bottom in terms of the industries, I'm seeing airlines have actually popped off the first page. They're on here a little earlier, but they're one of the top probably 12, 15 groups today. A number of other on there as well. But I think the airline charts are a couple that have rotated so quickly. So charts like Alaska all of a sudden felt like they were breaking down through the 50-day, felt like there was more distribution than accumulation, making a lower low. But look how quickly in 2 sessions, all of a sudden ALK looks like it's kind of an interesting play. Something like Delta has now broken above its most recent swing high, which is an interesting chart. AAL, boy, one of the weaker ones. So again, it's not across the board that they look super attractive. But you can see in this case, putting in a higher low for, which is potentially noteworthy, breaking above trendline resistance. So that group, again, I like themes that I feel like other people are not in yet. And I think airlines starting to appreciate being an interesting new upside play would be potentially pretty interesting. Dollar stores have been really unloved, and this is in the specialty retail group, Dollar General. You can see the relative performance here at the bottom. This stock was up 35% relative to the S&P essentially since the market low in December, and then has given up about half of that just in the last 2 months. And again, it's not necessarily done yet, but what I like is a higher low in the RSI. The fact that it's found support around 150, 250, which lines up really well to the low in September. So something like DG, again, it's something that's been off a little bit as opposed to something like an Apple, which has just been raging to the upside. I do want to highlight on the downside, there are a number of stocks that have broken down. We don't have a time to go through all of them. I'd encourage you to look through some of those charts. These are the charts you should be reviewing at the end of the day, in my opinion. Something like Cardinal Health, Central Ohio company, but breaking down through the 50-day on a big down day today, down almost 4% when the market's flat. This is the biggest loser in terms of the scooter rankings today. So there are a number of stocks that also showed some relative weakness. And again, I'd encourage you to spend some time looking through the scooter reports after the close. It's a really good way of figuring out what has happened. And I will just finish by showing you that most of the top 10 stocks, or many of them, about half of them, are semiconductors, which is usually the sign of a pretty decently healthy market. But we, friends, have to move on to the end of the show. And that means the 3 in 3 at the end of every show. 3 charts in 3 minutes. If these are not on your radar yet, they should be as of this moment, in my opinion. The first is the VIX. We didn't talk a ton about volatility in this show, but we've referred to this before. I have a lot of people pointing out the fact that the VIX is testing 12 again when it's hit 12 before at major market tops going back for the last couple of years. 12 has been the time when that sort of happened. So is this the end? And the problem with that is it happens some of the time. It works some of the time, but certainly not all the time. You had the situation in 2018 when the market started to rally, the VIX came down, which makes sense. They're inversely related, but look at how many times the VIX kind of tests 12 or even goes below it, and the market continues to go higher. So the VIX being low tells you we're in the conditions that have sometimes led to market tops, but not necessarily. And that's where I think trend following is really important. You want to be tracking the trend and see if you really get the confirmation of a trend exhaustion. We haven't seen it yet for sure. The second chart for the 3 in 3 is the breadth by captures. We've referred to this chart so many times, and this is on our Mindful Investor chart list. If you don't have that, shoot me an email, the final bar at StockCharts.com. I'll send you the chart list that you can have in front of you. But here we're looking at breadth in terms of the cumulative advanced decline line for the S&P, the New York Stock Exchange, mid-cap stocks, small-cap stocks. All 4 of these are in the green. And again, even though I talk about trend exhaustion, even though I'm looking for signals of some sort of top, the trend is undeniably positive, and this chart alone should confirm that for you. As long as these lines continue to go northeast, that tells you the trend is healthy, that tells you the breadth is strong, and that tells you the market's going higher. That's certainly what we've seen so far this week. In terms of what tells me, what are the things I'm looking for that might be a cautionary tale? At the beginning, that RSI bearish divergence potentially is one thing that I would be looking at. The second thing would be breadth. So here we're looking at the percent of S&P stocks above their 200-day moving average. We're just about at 80%, which means 4 in 5 S&P names are above their 200-day. That's a good thing, right? For the most part, I would say yes. The problem is looking back at the last 5 years when that has happened 100% of the time, and there's only 3 or 4 observations, so it's very limited. But every time we've gotten that high, that's so heavy on one side with so many stocks up, the market has pulled back. Now, every one of those times, to be clear, the market has resolved higher. The market has continued higher over the long term. But the breadth picture is so extended, it's similar to where we've topped out before. So again, the trend is positive. I think that's the charts we've shown certainly confirm that. I'm looking at signals like this, which put them on my radar. I'm now looking for some sort of breakdown confirmation. We have not seen it yet, but we'll be looking for it for sure. That is our show for today, folks, on the final bar. I want to thank you for joining us every weekday here on StockCharts TV. To wrap up the price action from a technical perspective, please keep your questions and your feedback coming. The final bar at StockCharts.com. Send us any questions at any time. Also, in the room during the show, in the Q&A room, put any questions you have. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a good night.